Good afternoon. Today we're going to talk about substantive tests related to accounts receivable. The primary test, the 800-pound gorilla, are receivable or confirmation of accounts receivable. We reduce detection risk by performing substantive procedures. The three types of substantive procedures are substantive test of transactions, which we would have done when we were testing controls, most likely. So you did substantive test of transactions when you completed the Vouch and Trace project. Substantive analytical procedures, they're a little different than the procedures we do in planning, a little more detail. Test of details of account balances. Substantive analytical procedures go into a little bit more detail than the analytical procedures we used in the planning phase. In this example, the customer had sales last year of $1.2 million. Industry-wide sales increased during the year under audit by 5%. So in planning, we'd probably just add 5% and say, gosh, we'd expect sales to be about $1.26 million. But when doing substantive analytical procedures, we look for more details and say, oh gosh, one of their largest customers went out of business in March, and one of their major products, a competitor introduced a product in September, which forced them to reduce the price of one of their largest products. So I'm going to adjust for those in substantive procedures. So I subtract the sales to the client that went bankrupt and the sales to for the product that had made a price adjustment, and I get a base of $984,000. Now to that, I'm going to add, for this customer that went out of business, I'm going to assume that they sold to that customer for a couple months before the customer went out of business. So I'm going to add 2/12 of the $96,000 back. And then for the product that faced competition, well, they sold it for $50 for 9/12 of the year, the first 9 months, and then the last 3 months they sold it for $30. Now, ideally, that factor would be 30 over 50 to represent the price decrease, but Excel reduced the fraction. So that would be my adjusted for substantive analytical procedures. I'd say, oh gosh, maybe the sales would be expected to be about $1.16 million. Age trial balance. We have the customer age their receivables by how long they're outstanding. So that 0 to 30 column means those are items we sold in, or the customer sold in December. Now they show a total of 14 million, but that doesn't mean they had sales of 14 million in December. That's of their December sales. These are the ones that haven't yet paid. And then the 31 to 60, those are items that were sold to customers that purchased something in November who have not paid yet. So most of them have paid. 61 to 90 days, those are sales in October that haven't paid us yet. 91 to 120, those would be September sales. And the over 120 would be August and earlier. Now, I think you can see the logic here that we're going to collect a much higher percentage of our December sales than we are those that were over 120 days old. So that $662,000 under 120 days, we're probably not going to see much of that. So we can use the age trial balance. We'll have the client present it. This used to be difficult, but now computer programs will spit one out in no time at all. And the age trial balance is going to help us with our accuracy, valuation, and allocation. Specifically, It's going to help us estimate our allowance for doubtful accounts. Figure 16.4 shows how we estimate allowance for doubtful accounts. And you'll see, if you look at the far left column, 0 to 30, that's just December, November, October, September, August, and before. So that's how long when we sold the goods. We estimate that we'll collect 97% or all but 3% of those credit sales in December. November, we estimate we'll collect 94 or all but 6%. So we can estimate how much we're not going to collect. And logically, I don't know if these are the right percentages or not, but logically, I do know that the older the accounts are, the less likely I am to collect them. I'm going to collect a higher percentage of my December receivables than my November, than my October, and so on. Auditing standards require us to confirm receivables. It's a required auditing procedure. The client won't provide us the necessary information to confirm receivables of their largest clients. So we'll issue either a qualified opinion or disclaimer of opinion. Qualified opinion, we have audited. That first paragraph is unchanged, and our opinion, except for the possible effects of the matters discussed in the basis for opinion paragraph, everything is fairly presented in accordance with generally accepted accounting principles. In the basis for opinion section, we're going to add a paragraph explaining the issue. The second paragraph is unchanged. There's no emphasis of matter paragraph with a qualified opinion. The responsibilities of management section never changes, and the auditor's responsibilities section doesn't change in these circumstances. Disclaimer of opinion. If we issue a disclaimer of opinion, then we're going to change the very first paragraph to say we were engaged to audit the financial statements of. We do not express an opinion because of the significance of the matter discussed in the basis for opinion section. We're going to add a paragraph explaining the issue. We're going to totally eliminate the we conducted our audit in accordance with generally accepted auditing standards. We didn't. We're not going to say we have a basis for an opinion. If we had a basis for an opinion, we'd express one. So we're just going to eliminate that paragraph. There is no emphasis of matter paragraph. The responsibilities of management doesn't change. The auditor's responsibility is going to be a total rewrite, total complete rewrite, because we didn't complete our responsibilities. We weren't able to fulfill our responsibilities. Two types of receivables, positive and negative. Now the positive confirmation on the left, in connection with our audit of financial statements, please confirm directly to our auditors the correctness of the balance. When we look down, it says the balance is $210,000. Now, they want the customer to respond to the auditors if it is correct or if it's not correct, either way. On the right-hand side is a negative confirmation, and it says, please examine the statement and respond only if it does not agree with your records. So, positive confirmation, we want you to respond either way. Negative confirmation, only if it does not agree with your records. So let's make sure we look at the letter here, the confirmation. The audit client is Hillsburg Hardware. Berger and Anthony is the auditor. So it's on Hillsburg Hardware's letterhead. Atwater Brothers is a customer of Hillsburg Hardware. So make sure you have all the players out here. This is going out to Atwater Brothers on the letterhead of Hillsburg Hardware, who's our audit client. and we're Berger and Anthony CPAs, the auditor. I guess one thing before I go on is negative confirmation. Positive confirmations are obviously better. Negative confirmations are used when a client has excellent internal controls and we want to reach out to lots and lots and lots of their customers. So a bank or a credit union typically we use negative confirmations, and they may just send it out to all of their customers. So Patty and I do our banking with Cesslock, the credit union here in town, and we get confirmations every year. The auditors may not sample. They may just send out a confirmation to everybody. We're talking about confirmation of receivables here, but they can confirm other things too. So sometimes negative confirmations are just fine. Let's take the credit union where the auditor is confirming their savings accounts. So my savings account at the bank, to the bank, that's an account payable. Now, am I worried if the bank says that they only owe me, if I have $1,000 in my account, and yet I believe I have $2,000, do I have incentive to respond? Yes. So sometimes negative confirmations can be very effective, especially when the client has excellent internal controls and when the goals of the customer line up with the goals of the auditor. So in the case of accounts payable, the auditors worry about them understating. If it's my savings account, I don't want them to understate it, so I would respond. By maintaining control of the confirmation process, we have to be involved. Think about what goes on here. So if we're auditing Hillsburg Hardware's accounts receivable, they have to provide us a list of all their customers. They have to provide us how much each of their customers owes them. They have to give us the address of their customers. As we saw earlier, the confirmation is going out over their letterhead. They're going to have to print the confirmations and they're going to have to sign them. This is confidential information. Hopefully the customers won't respond to the auditors unless our client gives them permission. So first of all this information comes from the client. Now if we're going to put 500 confirmations in envelopes, we may let the internal auditors help us, but we want to be in the room with them. We don't just ask them to do it. We have to be in the room. Second of all, we put the confirmations in the mailbox. A lot of your clients are going to have their own mail room, but we're going to take them off campus on the way home and drop them in either our office downtown or most likely a post office on the way home. And the reason we do this is there have been cases where somebody would mail the confirmations from the client's mail room. The client would open the confirmations and mail them to the auditor saying everything was okay. So we want to maintain control of the confirmation process so that it's difficult for the client to manipulate the results. If the customer doesn't respond to the confirmation, we have to perform alternative procedures. One alternative procedure, subsequent cash receipts. If the client says Miller Motor Company owes them $500, and on January 2nd there's a check from Miller Motor Company for $500, it appears that Miller Motor Company owed him $500. In fact, we know Miller Motor Company owed him $500. But what if that check appears on January 8th, 9th, 10th? So if the check appears on the 11th, do we assume that Miller Motor Company owed him the money as of December 31st? Or could that possibly be a January sale that Miller Motor Company is paying for? We don't really know. Another alternative procedure is what you did with the Vouch and Trace project. We're going to get a listing from the Accounts Receivable trial balance or Accounts Receivable subsidiary ledger, and we're going to vouch from that total to the invoice or invoices. The Accounts Receivable balance could be comprised of more than one transaction, but we'll vouch to the invoice or invoices and then to the shipping document, to the sales order, to the customer order, just like we did with the Vouch and Trace project. When I ask this question on a test, I always think, gosh, if they took the Vouch and Trace project seriously, this should be a very easy question. Test results either indicate that they didn't take the Vouch and Trace project seriously, or maybe it's not as easy as I think it is. Now, Table 16.4, if we look at existence, confirm accounts receivable, perform alternative procedures for confirmations that were not returned. Under accuracy, valuation, allocation, confirm accounts receivable, perform alternative procedures. Under the second, accuracy, valuation, and allocation, get an aged trial balance. So hopefully you can see the 800-pound gorilla. The procedure we're going to do for receivables is the confirmation, and then for those customers who do not return their confirmation, we're going to perform alternative procedures just like the Vouch and Trace project. We're going to use the aged trial balance to help us estimate what the allowance for doubtful accounts should be, because that's a valuation account. Tomorrow we're going to discuss accounts receivable cutoff as of December 31st, 2021. See you then.